Picture this. You wake up one morning and every major news outlet is running the same headline. US economy officially in recession. Your 401k is down 25%. Your neighbor just got laid off. The Fed is in emergency session. Most people's first instinct, panic, fear, rage. But what if that morning was actually the beginning of the fix? What if a recession isn't the disaster we've been trained to dread, but the reset this economy has been desperately needing for the last 15 years? Because here's what no one in Washington, no central banker, and no Wall Street analyst has the guts to say out loud. We've been running from a recession so hard for so long that when it finally arrives, it's going to be far worse than it ever needed to be. Today, I'm going to make the case that a recession isn't just inevitable, it's necessary. I'll show you the data, explain the macroeconomics, tell you exactly who stands to lose, and most importantly, what you should be doing with your money right now. Let's get into it. Let me open with some real-time numbers, because this isn't a theory. This is happening right now. Americans are currently carrying $1.28 trillion in credit card debt, the highest ever recorded since the New York Fed started tracking this in 1999. That number has gone up 63% in just 5 years. And here's the part that should stop you cold. More than half of Americans, 55%, are carrying credit card balances not to buy luxuries, not to go on vacation. They're using credit just to cover essential expenses, groceries, utilities, rent. That's not consumer spending, that's survival on borrowed time. Meanwhile, professional forecasters are paying attention. Recession probability on major prediction markets surged to 39.2% heading into 2026, nearly doubling from 22% just a few months earlier. Goldman Sachs puts it at a 30% and climbing. And for 2027, the odds actually hit 41%, meaning many investors think we dodge a bullet in the short term only to walk straight into it later. Gary Shilling, the legendary forecaster who correctly called the 1969-70 recession, has gone on record saying a 2026 recession is, in his words, almost inevitable. This is the backdrop. Now let's talk about why it's happening and why it might actually be a good thing. Macro 101, what a recession actually is. A recession is technically defined as 2 consecutive quarters of negative GDP growth, but in plain language, it means the economy is shrinking, businesses earn less, hiring slows or reverses, consumers spend less, asset prices fall. Now here's what they don't teach in school. An economy, like the human body, runs on cycles. Expansion, contraction, expansion, contraction. These cycles serve a purpose. They're the economy's way of flushing out excess, correcting prices, and reallocating resources from dying industries to growing ones. The economist Joseph Schumpeter called it creative destruction. Old businesses fail, new ones rise, workers move to more productive jobs. Capital flows to better ideas. Recessions are painful, yes, but historically, they're also what reset the conditions for genuine, sustainable growth. The problem is, since 2008, we stopped letting the cycle complete. Every single time the economy started to contract, the Federal Reserve cut interest rates, or Congress approved another round of stimulus. 2009, 2011, 2015, 2019, 2020, the same playbook over and over. And instead of a correction, we got a 15-year postponement. Think of it this way. Imagine you skip going to the dentist for 5 years because you're afraid it'll hurt. Every year the problem gets a little bigger, a little more expensive, a little more dangerous. Eventually, you're not dealing with a cavity, you're dealing with a root canal. You could have avoided the whole thing, you didn't. The US economy has been skipping the dentist since 2008. Here's what skipping the dentist looks like at a national scale. Near zero interest rates for over a decade. When money is essentially free to borrow, everyone borrows more than they should. Businesses, consumers, the government. And when rates finally had to go back up, which they did, all that debt became brutally expensive overnight. $39 trillion in gross national debt. That number was under $6 trillion in the year 2000. That is a 520% increase in 25 years. The annual deficit is currently running at 6.4% of GDP, and the Congressional Budget Office projects it could hit 9% by 2035. That's not a budget gap, that's a structural emergency. A housing market that's essentially frozen. Prices are still elevated from the pandemic boom, but nobody can afford to buy and nobody wants to sell because they're locked into 3% mortgages. So the market just sits. Prices disconnected from income. First-time buyers locked out entirely. Banks are already tightening. The Fed's Senior Loan Officer Survey, one of the most reliable leading indicators in all of economics, is showing stricter lending standards heading into 2026. Banks don't tighten for no reason. They tighten when they see risk coming. This is not a healthy economy running hot. This is an economy that's been propped up with debt and cheap money for so long, it's forgotten what it's like to stand on its own. 5 reasons we actually need a recession. So let's talk about the case for a recession, because there is one, and it's stronger than you think. Reason 1. Zombie companies are killing real growth. There's a term in economics called a zombie company. It describes a business that earns just enough to pay the interest on its debts, but never enough to pay back the principal. These companies can't invest, can't innovate, can't raise wages. They just survive on refinancing, propped up by cheap credit and investor tolerance. Since 2009, entire sectors of the US economy have been run by zombies. They block the flow of capital that should be going to genuinely productive businesses. They suppress wages because they can't afford to compete for talent. They create the illusion of employment without creating real economic value. A recession kills off zombie companies. It's brutal, but it's how the economy reclaims its immune system. Reason 2. Japan already showed us what happens if we don't. Japan's property and stock bubble collapsed in 1990. Their response? Keep the zombie companies alive. Keep the bad loans on the books. Avoid the pain. The result? Japan's GDP in 2020 was barely higher than it was in 1995. They call it the lost decade, except it lasted 30 years. America is running the same playbook Japan ran. And if we don't let this system clear, we are staring at our own version of decades-long stagnation, not a recession, a slow grinding, indefinite plateau. Reason 3. The debt has to be purged, or it purges us. Debt doesn't just disappear, it compounds. And at 6% of GDP in annual deficits projected to rise to 9%, the US government is not on a sustainable path. A recession forces deleveraging. Households cut spending and pay down debt. Businesses restructure. Even the government, when economic pain forces the conversation, may have to address what it owes. The alternative? We just keep borrowing, keep printing, keep inflating. Until the debt crisis arrives on its own terms, on a timeline we can't control, with consequences far more severe than any managed correction. Reason 4. Asset prices are disconnected from reality. The stock market is near all-time highs. Housing remains historically unaffordable. The Shiller-Cape ratio, a measure of how expensive the stock market is relative to earnings, and the Buffett indicator are both hovering near record territory. When asset prices disconnect from underlying fundamentals, they don't stay disconnected forever. They correct. The only question is whether it's a gradual re-rating or a sudden crash. A managed recession that brings valuations back to earth is far better than the alternative. A chaotic crash that vaporizes retirement accounts overnight with no warning. Reason 5. The middle class only wins in a reset. This is the part that doesn't get enough airtime. The wealthy own assets, stocks, real estate, businesses. When those assets are artificially inflated by low rates and stimulus, the wealth gap doesn't just widen, it accelerates. The people who already own things get richer. The people trying to start owning things get priced out. The geographic and income divergence in financial stress heading into 2026 is sharper than at any point in the past decade. younger borrowers, lower income households, communities where the cost of living has gone parabolic. These are the people being crushed by the current system, not protected by it. A reset doesn't just clear debt, it clears the artificial barrier that makes it nearly impossible for ordinary people to build real wealth. Now, I would be doing you a disservice if I didn't say this clearly. Recessions are not painless, and they are not painless equally. When unemployment rises, it doesn't hit executives first. It hits hourly workers, contract employees, service industry workers, the people with the least cushion. When small businesses collapse, the owners of those businesses often lose everything. Meanwhile, large corporations with access to credit markets and legal teams restructure, survive, and acquire assets at discounts. The people who call loudest for a cleansing recession, economists, analysts, pundits, often have investment accounts, savings, and career stability that insulates them from the worst of it. That's the honest reality. A recession is not a magic reset button that distributes pain fairly. It hits harder at the bottom, which is exactly why, if you're watching this, you need to be using this time right now to get your financial house in order. Not because the recession is coming to punish you, but because preparation turns a crisis into an opportunity. What to do right now? Alright, let's get tactical. Whether you believe this recession is coming in 6 months or 2 years, it doesn't matter. These steps make your finances stronger regardless. Step 1. Stop surviving on debt. If you are in that 55% using credit cards for essentials, this is your priority above everything else. The average credit card interest rate right now is north of 20%. You cannot build wealth at 20% interest. Get on a zero-based budget. Cut variable expenses. Find a side income stream. The goal right now is to stop the bleeding. Step 2. Build a 6-month emergency fund. The standard advice used to be 3 months. In a recession environment, that's not enough. Job losses can last longer than 3 months. Industries can restructure. Aim for 6 months of essential expenses in a high-yield savings account, which right now can still earn you 4 to 5% while you wait. Step 3. Don't panic out of the market, but do evaluate your risk. Recessions create buying opportunities, not selling opportunities if you have cash to deploy and a long time horizon. If you're 30 years old, a 30% market correction is a gift. If you're 58 and retiring in 4 years, that same correction is dangerous. Re-examine your asset allocation now, before the correction, not after. Step 4. Position for asset price corrections. If housing corrects and some markets are overdue, first-time buyers who've been priced out may finally get their window. Start building that down payment fund now. Keep your credit score healthy. If rates drop alongside a recession, a prepared buyer can move fast when the opportunity arrives. Step 5. Recession-proof your income. The best recession hedge isn't a stock ticker, it's having skills that can't be easily eliminated. Build a second income stream. Strengthen your professional value. Make yourself hard to lay off. The people who come out of recessions ahead are not the ones who timed the market perfectly. They're the ones who kept income coming in. Here's the truth. Nobody wants a recession. I don't. You don't. The Fed doesn't. The politicians running for office definitely don't. But wanting something and needing it are different things. The economy has been running on debt, on stimulus, on artificially suppressed rates, and every year we avoid the correction, the eventual one gets bigger. The debt compounds, the zombies multiply, the housing market gets more frozen. The gap between those who own assets and those trying to build them gets wider. A recession isn't a punishment, it's a correction. And the longer we postpone it, the harder it corrects when it finally comes. The best thing you can do right now, today, is stop waiting for someone to fix it at the macro level. Get your own financial house in order. Build the cushion, clear the debt, position yourself to benefit from what's coming instead of being buried by it. Because here's the thing about recessions that nobody talks about on the highlight reel. The people who came out of 2009 ahead, they were the ones who were ready. Be ready. If this video made you think differently about the economy, share it. Someone you know needs to hear this.